Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Monday. Well, let's take a look at what's going on at a macro level. US economy added the fewest jobs in 2.5 years in June, with US non-farm payrolls showing employers added 209,000 jobs last month, which was well below economists' forecasts, while the previous month's numbers were revised lower. However, the unemployment rate falling to 3.6% in June from 3.7%, and average hourly earnings rising 0.4%. In response, the yield on the 2-year Treasury note fell more than 10 basis points to 4.9%, having hit a 16-year high last week. The 10-year down to 4.02%. And expectations for a 25 basis point rate hike from the Fed at its meeting later this month have risen to 95%. However, traders have priced in a lower chance of further increases later in the year. Well, the US dollar slumped on signs of a less resilient US labour market, and the Aussie dollar was up around 1% against the greenback, currently at 66.4 US cents. Elsewhere, US Treasury Secretary Janet Yellen has wound up her visit to China, acknowledging that the two countries remain at odds on a number of issues, saying that President Biden and I do not see the relationship between the US and China through the frame of great power conflict. We believe that the world is big enough for both of our countries to thrive. Secretary Yellen urging more cooperation between the two superpowers on economic and climate issues, while criticising punitive actions against US companies in China, and said that Washington is not seeking to decouple from China's economy, as doing so would be disastrous for both countries and destabilising for the world. Well, we're about to head into global earnings season. Let's get a sense of what can be expected. Mary Manning joining us from Alphinity. Mary, good to see you.
Thanks very much for having me.
Can we just start actually on, we were having, just before you came on, I was talking about rates and where you think we're likely to go. Of course, we had those latest job numbers out of the States late last week. What is that telling you? A bit of a mixed picture there.
Yeah, I think for me, I was focused more on the unemployment rate, because 3.6% unemployment is very, very low. I think the chart you had was going back to 2018, but if you go back to like the 1990s or the 1980s or however far back that goes, 3.6 is a very, very low unemployment rate. And so, you know, it is suggesting that the economy in the US is still quite hot, and forecasts that rates are going to be cut in the near term are probably premature. I think it's also important to remember that when COVID hit, a lot of central banks talked about how this inflation was transitory, and you know that ended up being quite wrong. So I think the word that's being used now is entrenched. Is this inflation entrenched, and is it going to keep being at high levels longer than people think? So that's sort of what I'm watching going forward. Number one, the labor market, and then number two, looking at inflation and seeing after the year-over-year math comps sort of settle down, is inflation potentially entrenched at a higher level than people think?
All right, so perhaps that's with a view to rates remaining higher for longer, but also what of the prospect for recession? And let me frame that by asking you, given that outlook, what your expectation is for earnings season as a result.
Yeah, so at Alphinity, we are bottom-up stock pickers, so we don't make a macro call on rates or unemployment or recession and then orient the portfolio around that. But we are very, very keenly focused on earnings. And what we're seeing so far is first quarter was actually okay. You know, there weren't a lot of huge blow-ups, but the commentary was a little bit cautious, particularly out of the US and in some of the consumer stocks. So then if you think of what happened in the first half of 2023, and particularly in the second quarter, stocks went up a lot. And so it's not like we're at a very low level and, you know, stocks, there's not a lot of expectations there. So I think this earnings season could be a bit bumpy because expectations have risen a little bit, and certainly the stock prices have risen. So there's not a lot of room for error there. Yeah, I guess one area that's very important in this earnings season is the FANG stocks, because they have, as I'm sure everybody knows, you know, there's been those 7 stocks that have really driven the market in the first half. And so those stocks continuing to delivering on earnings is going to be important to keep that momentum in the markets.
Yeah, because we talk about the 7 stocks and that narrow leadership we're seeing there, but do you think that is accurate, that interpretation of clearly some concern that of how narrow that is?
So I think, you know, FANG Man is a acronym that people like to use, and now obviously Tesla is in there, so you need to add a T somewhere. But if you actually look at the stocks that are in that 7 that have led the market rally, they're very, very different stocks. You have a couple of stocks, these are the ones that we own, namely Microsoft, Google, and Nvidia, that are beneficiaries of AI, and something has definitely changed in their earnings and in their outlook for the medium term that justifies, certainly at least some of this move. But then you have stocks like Tesla, which is in a very, very deep earnings downgrade cycle, like very deep, and the stock is more than doubled. So the earnings versus the stock price, looks like that. And those kind of stocks, I think there may be a day of reckoning, because at some point people are going to have to look at the earnings and the underlying fundamentals, and they're going to have to match up with the stock price. And then you have others like Apple and Netflix, which are sort of in the middle. So I think there'll be quite a bit more divergence between those big 7 mega cap stocks in the second half of this year.
And of course, the recurrent theme recently has been all around AI.
Yeah.
As a result, any of those stocks in that related field have done extremely well, and investors once again questioning whether that is sustainable. What do you need to look for with a company that attaches AI to what it's doing at the moment?
Yeah, it's funny because if you search any of the transcripts from the first quarter, generally AI would be mentioned like 3 or 4 times. And in most companies it was mentioned like 50, 60 times. And so everybody is jumping on the AI bandwagon. As I mentioned before, Alphinity is focused on earnings. That's our whole investment process, is to look at earnings upgrades. And so whether it's AI or anything else, we're looking at what is the implication for earnings. Nvidia, obviously you've seen that is making a huge impact on their earnings, and that's the reason that we own that stock. Microsoft, also you can see the impact in earnings via pushing the ChatGPT through its other products, and also in cloud. Google, the same thing, you will see that in cloud, and also because it's an AI company. But other than that, there's not very many companies, particularly in the mega caps, where you can point to this is an AI hype, this is actually, you can see it in their earnings. The second thing I'll say though is that potentially the biggest benefit of AI is not just in the tech sector, it's across other sectors, and it's on the cost side. And I actually am quite bullish about that as a productivity gain, but that's like a 2 to 5 year sort of thing. So some of these stocks that maybe run on that, you're not going to see that in their earnings for quite a while.
So you're talking about when AI is integrated in our everyday life, essentially?
Yes, absolutely.
Yeah, all right. Mary, I gather you've just recently been to China. Now, some concern there, of course, of its growth rate, whether we're going to see more stimulus out of there. What did you sort of get out of your trip on the ground there?
Yeah, well, it was good to be back. Like many investors, I hadn't been since before COVID, and so it's really helpful to be on the ground and to get that perspective. I actually think that China reopening is on track versus my expectations, but it's not the same pathway that other countries took out of lockdown. So it's not a very sharp V recovery. And that makes sense. China was locked down for 3 years, which is very different than being locked down for 3 or 4 months. So I think reopening is on track, but it's more of a U than a V. And then there is some concern over the long-term trajectory. The GDP target for this year is 5%, and as we know, China's struggling to get to 5% without stimulus. So what does that say about the underlying growth rate? Is it 3? Is it 4? I don't know, but it's something way less than the 6-7% that we are used to in like maybe a decade ago. So I think that has really important implications, obviously, for Australia, for demand for commodities. It has really important implications for multinational companies that look to China for their growth. And it has geopolitical implications. I saw your clip at the beginning about Yellen going to China. That is a tense relationship, and it doesn't seem to be getting any better fast.
Yeah, well, she says perhaps, there's reason to be optimistic, but we'll wait and see on that front. So what is your exposure that you have in China at the moment?
So we have no direct exposure, but we do have indirect exposure through our multinationals. LVMH and the luxury side is a good example there. Starbucks, L'Oreal, and then on the industrial side, we own stocks like Otis.
All right, you mentioned those luxury goods. We've seen them do very well, particularly in Europe. Can you tell us your view as to what's going on with that sector?
Yeah, still definitely like luxury. I mean, back to your original question about unemployment. Even though unemployment is low in the US, consumer confidence is also low. It's like people have a job now, but they realize that the labor market, it might not get any stronger from here. So we have some concern about the US consumer, like on the low and mid end, but across the world, high-end consumers are very, very comfortable, and they continue to buy high-end goods, and they continue to want to travel, and that part of the consumer market seems much healthier than some of the other options.
More broadly, what are you seeing in Europe, particularly as far as opportunities and equities at the moment?
Well, I'm seeing a lot of people in Europe. That's, my daughter has Snapchat, and on her Snap Maps, like all of her friends are in Europe.
Yes,
and
likewise.
Yeah, everybody's in Europe. And so I guess that's the first thing to say is that consumer stocks in Europe or stocks in Europe that benefit from people traveling there are probably doing okay. Europe in general, though, outside the luxury stocks and some of the German industrials, the UK is obviously hurting quite a bit. And so our exposure to Europe is generally on that industrial side and then through the luxury goods.
So Mary, regionally, where are you seeing the greatest opportunity at the moment?
So we don't really organize things along regional lines. The majority of our portfolio is in the US, but within that, the majority of our portfolio is in multinational companies. So we like to have a broad, diversified exposure to what's going on globally. But right now, the majority of our portfolio is in the US.
Any emerging markets?
We own Mercado Libre, which is it's listed in the U.S., but it's a Brazilian stock. That's been a very good performer year to date. There is some things going on in Latin America, particularly in Argentina, which are a concern for the second half of the year. So we have a relatively smaller position size there. But Mercado Libre, from a structural perspective, from an ecosystem stock perspective, we really like it.
Mary, always great to get a view of your strategy there at Alphinity. Thanks so much for joining us.
Great, thanks for having me.
All right, that is the global view for this Monday. Just before we go, let's check where we're likely to get going, because you can see SPY futures up just over 1/3%. So that is, of course, after 2 days of heavy selling late last week. So we are just moments away. Stay with us for the open.